Hey everyone, welcome back to Corporate Decoder. Today we're diving into a 10Q filing, so complex it's practically a real estate investment trust wrapped in a tax shelter with a side of legal jargon. Get ready because this CaliberCos report is a wild ride through the world of alternative assets and we are about to decode it. This filing is for the quarter ending in March of 2025. It is basically an update on how the company is doing. But here are a few words on the top that might give you an idea of what we will find. The company has incurred operating losses and their debt is becoming due, which raises substantial doubt about the company's ability to continue as a going concern. If you appreciate getting straight insights from corporate documents, make sure you're subscribed. We also have a Discord community linked in the description below. CaliberCos is based in Scottsdale, Arizona, and they're all about managing and investing in real estate funds. They handle everything from finding properties to managing construction, trying to give investors solid returns. Before we really begin, there's a note explaining that the term company refers to CaliberCos Inc. and its direct subsidiaries. You'll also see references to consolidated funds, which means Caliber's consolidated variable interest entities. Basically, when you see Caliber, we, us, or our, they're talking about everyone all together. Alright, let's look at the hard numbers. On the balance sheet, cash decreased from about $1.8 million at the end of last year to just under $1 million in March. Real estate investments are fairly stable at around $21.5 million, but the amount owed to them by related parties increased a bit from $6 and $9 million to $720, and all of which is side notes payable. Their debt increased a bit from $50 around $21 at is money they have yet to receive. Looking at the liability side notes payable, their debt increased a bit from $6.9 million in March. Real estate investments are fairly stable at around $21.5 million. Moving to the income statement for the quarter, here's where things get interesting. Total revenue took a nosedive, falling from about $23 million to just $7.3 million. That's a huge drop. Consolidated hospitality revenues, which seem to be their real revenues driver, went from $18.1 million to only 30 is still not good. On the expenses side, costs are down too, but not enough to offset that revenue drop. Interest expense is up a bit, and the net loss before taxes is sitting at negative $4.6 million compared to a $5.3 million loss the same time last year, so the losses are less. But the big picture isn't great. Fewer sales means tough times, and finally, the basic and diluted loss per share is also down from negative 3.5. The total liabilities are still way higher than the total equity. This is not Warren Buffett type of company, as he hates companies with high amounts of debt. Looking at the cash flow statement, things aren't much brighter. They used $1.7 million in operating activities and another $100K in investing, and only gained $123 from financing activities, which means less cash on hand. Something else to keep an eye on is something called reverse stock split. It's like taking a bunch of small slices of pizza and making them into a few big ones. The company is trying to artificially inflate the price of their stock by decreasing the number of shares on the market, which must stay above $1 on the Nasdaq. This usually means that the price is going to crash again. To add to the story, they secured a deal for about $1.7 million through senior secured promissory notes to Mast Hill Fund. Also, the company may sell an issue to the investor, and the investor may purchase from the company up to $25 million of common stock, but they have an exchange cap. Shareholder approval is required to go beyond $78,441 shares of common stock. Here's the real problem. They've got a portfolio of corporate notes maturing soon. Think $26 to $1 million within the next year. To pay for them, they want to try raise 20 refinance, some existing 12-month notes into 36-month. They are depending on people to put more money into the company. They hope that cost reduction will help them dig out of the hole. They also have around $8.2 million in receivables that they have yet to receive and want to collect the funds. Okay, let's step away from raw numbers for a moment and check out accounting policies. These describe how the company actually counts their money. They discuss various accounting treatments, such as revenue recognition for their hospitality revenue. It is standard for a company this size. There is an extensive note about variable interest entities. In short, the company owns many of its investments in partnership with others. And those entities might or might not be included in the financial numbers depending on who has the most control. It is the primary beneficiary if it holds a controlling financial interest in a VIE. If they are, we reflect their assets, liabilities, revenues, expenses and cash flows on a gross basis, and the interest in the VIE. If they are, we reflect their assets, liabilities, revenues, expenses and cash flows on a gross basis, and the interests in the VIE are included in non-controlling interest in the consolidated financial statements. They capitalize costs, including certain indirect costs incurred in connection with their development and construction activities. The reason that companies capitalize costs instead of expensing them immediately is that capitalizing costs can make a company's financial statements look more attractive in the short term. Capitalizing costs can boost profits in the near term. It can also lead to higher taxes later on. There are, from time to time, various claims and legal proceedings arising out of their ordinary course of business, but I don't believe that any of these claims or proceedings will have a material effect on their business. The purchase agreement that they entered with Mars Hill Fund, if you remember from the beginning of the video, that is how the company has secured funding. They issued the investor a senior secured promissory note in the aggregate principal amount of up to 1,666, 67, 66, 66, and 67, 6. All of these notes for $26.4 million is maturing soon. Low cash, low equity, high debt. Raises substantial doubt about the company's ability to continue as a going concern. They still feel confident and believe they will address these issues, but the report says that they cannot be deemed probable. Lastly, there is quite a bit of technical stuff regarding the shares, but this is probably not that important. The risk sections highlights the obvious stuff. Real estate values can change, changes in interest rates, bad stuff happening and making people not want to travel, like regional conflicts. Basically stuff is happening and they're getting less predictable, so keep an eye on it. The exhibit index lists all the legal papers that go with this document. This part is mostly for lawyers, so we won't spend too much time on it. Alright, that's our breakdown of CaliberCos' latest filing. It's not a pretty picture, to be honest. Declining revenues, a concerning level of debt, and a warning about their ability to continue operating. Their stock also might be delisted. The reliance on secured funding and more future funding is not sustainable. They are depending a lot on things going right. Despite this, the company is taking active measure, cutting down costs, negotiating with lenders to solve this. Now, here's the most important bit, the share price. The stock is really cheap. There could be a big upside, and there is a world where some big development gets approved, or a fund does particularly well, and suddenly the stock could shoot straight up. The main thing is that it's extremely high risk. Alright, what's your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.